Alrighty then. So it's been a while since we've talked. Since we had spring break, we had the exam, we had some other things going on. I'm going to do a review of that exam just to kind of reinforce it. The final will be comprehensive. A couple things that are important terms are, the liquidity issue that'll keep coming up. Again, I think we kind of not have beaten it to death, but man, it is important. Having access to cash is huge. So if you're paying attention to current events, I mean, there is a lot going on, especially like some of these bank failures. The Silicon Valley Bank. It emphasizes a lot of things we've been talking about. Number one, liquidity. Those guys had the assets, but they didn't have access to the cash. When there's a run on the bank, all the people, or enough people, come to the bank demanding their cash. And since the bank has got it loaned out to other places where they can't get at it immediately, they have a liquidity issue. They don't have the cash to give to the people, and the bank fails. So bad on them. The other thing that happened is, where was their money? In bonds. And bonds that they bought at a lower interest rate. So, they obviously would have preferred to buy bonds or, be holding bonds that had a higher interest rate, but those weren't available when they wanted to buy them. Well, since they're holding these bonds, and now new bonds, fresh bonds are coming out that pay a higher interest rate, nobody wants their, old bonds that are paying the lower interest rate. So the price that their bonds are worth if they sell them is going to be less. They're looked at as less attractive. So they got a whole portfolio that was comprised of all these bonds that were, not all that valuable. And the way banks work, they work on very small margins. They take in people's money and they pay them a small interest rate, and then they loan it out at a slightly higher interest rate. But in the meantime, they get all that money to work for them. They invest it. And so bank runs can happen. Banks, don't have, they have certain regulations to have a certain amount of money on hand, but sometimes those things get waived, and especially that was the case here. So it's interesting. And then other things like Bitcoin, for example, and gold, as they should, gold is actually, I'm not a huge proponent of holding gold for investment, but it does have some, it's not dropping like stocks are, although it never appreciated. If you held stock for the past 20 years and gold for the past 20 years, your stock portfolio would have, obviously quadrupled or whatever, many 5-10x return, whereas the gold just kind of languished. It didn't do a whole lot. But now gold is reasonable. It's up maybe 20% for the year, which is not bad. But anyway, and Bitcoin's kind of separated itself from some of the other crypto. When people talk about crypto, keep in mind that they lump things together, and Bitcoin and even Ethereum to a certain extent are maybe higher grade, maybe more investment quality in some of the altcoins and other things. So lots of interesting things out there. Lastly, I'll talk about the whole FDIC insured. For most of us, it's not a big player because most of us don't put huge amounts of cash into bank accounts. But if you read or see the little sticker on any bank window, you'll see that accounts are insured up to $250,000. So $250,000 for just about everybody is more than enough. But obviously, in this Silicon Valley Bank, a lot of people had more than that. So there are some fairly high wealth individuals. But because the government stepped in, they actually made those people whole as well. So anyway, lots of interesting stuff out there. Let's jump into the test, talk about that. So opportunity cost, we know what that is. You make one decision and it affects every other decision. And it just keeps going and going. So I'm not going to hit too much. You can look at these questions. Retirement planning, you can't start early enough, obviously, because of the time value of money. If you're not living within your means, you only have one real option, and that's to get your spending back under control. Liquid asset, so cash in a savings account. There's lots of liquid type things. Obviously, cash is kind of the definition of liquid, but even stocks or other things might be considered very liquid because they can settle in 3 days. But again, the caveat with stocks and other things is just because you can sell them in 3 days doesn't mean you're going to be able to get, the full amount of money that you paid for that asset. So again, coming back to this situation, if the banks would have said, oh, we're having a run, we're going to sell all of our bond portfolios to give people cash, well, guess what? Your bond portfolio is not worth what it was when you bought it. So it's there we've got a combination of liquidity and just asset valuation. Student loans, car loans. Okay, so the thing you should pick up here is that those things are held for longer than a year, which means long term. Family's wealth, net worth. So net worth is assets minus liabilities. Monitor your debt level. Yep. Cover your monthly payments. Time value of money on question number 9 there. Compounded rate. That means earning interest on interest. Same for 10. 11. Head of household, just a tax filing category. Yeah, the other ones are self-explanatory. Married, single, or married filing individually. And then there's this weird head of household thing. Just make sure for head of household, you need to have some sort of dependent there. This lady purchased a stock. She made some money, so she had $15,000. How long did she have it? Longer than a year, so long term, right? Purchasing, reduce your tax bill. Why the home? Because the mortgage interest is tax deductible. We talked about 15 already. Short-term deficiencies. Yep, liquidity again. So, credit card. Yep, you can get that money quickly. Potential cost, though, of the finance charges. And with a credit card, if you're using it doesn't say using credit card, but credit. But keep in mind, if you use a credit card, it's not, there's a credit charge and there's also a user fee associated with that. We talked about stopping payment on a check only if it hasn't cleared. So most checks are electronically processed, so stopping payment is more useful now in lost checks, lost documents. Overdraft protection, yep. Kind of a necessity, and just things happen. And you don't want to be writing hot checks or whatever, because there's nothing you can say and they can charge you whatever fees they want. All the following situations are valid, except for day-to-day. You can only do that for so long. It's not valid. Be a convenience user, your credit card paid off and you won't pay any interest at all. Cash advances, yep. They will charge you a fee and charge you interest from the start. We had some puppies this week, so we got a lot more dogs in the house. My apologies. Which of the following statements is true about credit cards, visas? Excellent source of emergency funds. Yeah, certainly. Quick, easy. Gives you about a month to think about it. We'll figure out where you're going to get that money. And hopefully that money is, in a different investment, something like that still has some liquidity, but doesn't necessarily need to be available that day. Yep, convenience user again on number 24. APR, annual percentage rating. Good practice. Yep, it all works out. They're much easier to deal with. Everybody's much happier. Collateral is what secures the loan. If you don't have collateral, you don't have a secure loan. And that's not a good position for the bank. Banks, what do? They just incorporate that risk into the interest rate. And so now you're going to be paying a considerably higher interest rate because they don't have security. Which kind of loan generally charges low interest rate? Obviously the secured one. There we go. Don't co-sign loans. So yeah, the lender will seize your assets, probably before they'll seize the others. Purchasing a home, you as the buyer do not pay the real estate commissions. Homeowners associations, so yeah, there's advantages and disadvantages. They can definitely, be kind of onerous and in your chili, or if you have a screwy neighbor who wants to paint their house bright yellow or something like that, they can shut that down. So anyway, it's a judgment call. Fixed rate on mortgages, payment will remain the same for, if it's a 30-year loan, it'll be the same 30 years from now. ARM, adjustable rate mortgages, so more aggressive. Normally a lower interest rate because the bank's got some protection here. If the interest rates go up, they're going to start to increase the interest rate on you, so they've got a bit of protection, so they can offer you a little bit lower rate. They're not taking that 30-year mortgage view where they have to set an interest rate. Do not ignore risks. That's an insurance situation. That's not a good idea. Just pretend like they don't exist. Not a good idea. Comprehensive. That covers all those cats and dogs kind of things. Deductible. That's how much you pay before the insurance company starts to pay. Homeowners policy. Yep. Flood insurance is never offered by a private company. It's got to be funded by the federal government because, again, it's outside of the concept of insurance, since a huge number of people can be affected at once, which invalidates the insurance philosophy. Personal property floater, it could be called a rider, it could be called a codicil, an addendum, whatever. The important thing is, if you've got some stuff of value, over and above what you think is normal, you want to mention it to the insurance company, or make sure that it's noted in the policy, or scour that policy, make sure there's no limitations like jewelry is limited to $1,000, knowing you've got much more than that. Best way to reduce your homeowner's premium, increase the deductible. And health insurance, just about any kind of insurance, if you can get it on a group policy, that's best. And that's why this, even if you could, typically the big savings with the employer offered insurance. Sometimes it's subsidized, but just about in all cases it's spread out over a group of folks. So that's that. So now we're going to jump into the actual lecture. Investing in stocks. This is kind of different because stocks were the go-to investment, and they will be again. But right now, with the interest rates going up, and it's for the kind of investing I was doing in high-tech areas, things like Silicon Valley Bank, obviously that sector is not doing well right now. People are not, most people are kind of hunkered down right now, and they're waiting to see where things go. But anyway, there will be a time where stocks are going to come back, and it's probably not too far in the distant future. But the reason why you do stocks, and again, don't think that I'm saying just individual stocks. These could also be purchased through a mutual fund. Buying individual stocks probably is not the way for you to go, but having a knowledge of what stocks are and what makes up your mutual fund portfolio, that is kind of important. So what happens is stocks, again, you have an equity position in a company. You own a little piece of that company. And so we'll jump in. They're talking stock exchanges, New York Stock Exchange, all this stuff. If you're buying stocks, most of it's kind of transparent. The day of all these floor traders and all that stuff, now we're talking electronic means. It's usually done digitally, and the presence, the stock exchange still exists, and there still is very valuable real estate, because believe it or not, even though speed of electricity is 186,000, whatever the units are, very fast, it still makes a difference where people want their computers that much closer within feet of that stock exchange to speed up the transactions. So it still exists, but the man in the middle is just too slow. And too expensive. nobody wants to pay commissions anymore, and but the relics still exist. If you're buying a stock, do I care exactly what exchange it's traded on? Not a whole lot. I mean, if it's something that's traded on the Canadian Mining Exchange, I'm going to be kind of scared, because that's kind of the Wild West. The mining stocks, especially up there in Canada, have a reputation for being pretty risky investments. New York Stock Exchange, there's a bit of clout there. There's certain requirements for the company to make it, but there's a lot of companies, the Googles and the Alphabets and the Metas, and before they all changed their names, they were not New York Stock Exchange. They were coming up on NASDAQ. They were coming up on bulletin boards and things. So anyway, they talk about some traders, specialist traders, brokerage firm executed by specialists. Again, this is kind of nostalgia. Not so worried about the stock exchanges. And then the American Stock Exchange and some, regional stock exchange. I don't really much care. What is important, though, is let's say you want to buy, stock in some foreign company, some, international type thing. You don't want to go to the, Vietnam or the Hong Kong or the whatever stock exchange. No, you want to find what's traded on one of the American stock exchanges of those companies. So they will have foreign companies will have a presence on U.S. exchanges, and we are still pretty dominant. I guess London's got quite a bit going on as well. But anyway, if you tried to buy a foreign company on a foreign exchange, all the fees and stuff, the exchange, the currency exchange, the tax implications, you'd probably break several laws and create yourself a nightmare. Pretty much don't need to do that. You would find the company. But again, buying individual stocks and doing that kind of stuff is maybe beyond the scope of this class. What I'm trying to show, though, is just what stocks are, and when you see a mutual fund, and we'll have a section on mutual funds, but we'll look at a mutual fund and you'll find out that they have a portfolio, just sort of a folder of stocks, and they'll have their 10, largest holdings or whatever, and those are going to be individual stocks. So if you're going to be intelligent about trading mutual funds, you have to have some cognizance, some knowledge of stocks, because for the most part, mutual funds are just made up of stocks. Now, mutual funds can be made, they can have real estate components, they can have bonds, so that's why I'm kind of putting that caveat out there, but 99% of them are probably made up of individual stocks. Okay, over the counter, electronic, again, do I care? Not so much where they're sold. I do not want to get, I have bought penny stocks, but again, that's not investing, that's speculation. But anyway, so if you go on to whatever, TD Ameritrade or whoever your chosen broker is, the knowledge of what exchange it's being traded on is not that critical. You're more concerned with the actual company itself, the company you're buying. So after hours trading does happen, but the margins are pretty thin, and you can have some wild price swings. Most trades are done, during business hours. Price quotations. Used to be you'd pay a premium for real-time quotes. Now real-time quotes again, and that means the current price are typically free. Stock brokers, not for most of us. There just aren't that many available anymore, and they're kind of obsolete, useless, whatever. If you're a high wealth individual, you might have somebody you work with directly to do that for you, but the days of stockbrokers are kind of gone. Financial newspapers, now they all have their digital equivalents. By the time, especially financial information, by the time they print the paper, it's OBE. The other thing about, now there are good financial documents and research papers and stuff, but that's longer term, not for quotations so much. And again, they'll show a lot of different stuff with sort of tabular data, you know, a string of numbers that's, number one, not very intuitive and just not nearly as powerful as charts. Interactive charting is the way things are done now. So this is useless. The high and low of the day, the stock name. So this may be the company, or perhaps it'd just be something like ZUG. They'd call it a ticker symbol if they're, you know, fortunate enough to get that name. Ford Motors, for example, is just the letter F. Anyway, so they've got a stock name, a yield if it's, you know, doing a income stock, price to earning ratio, volume, how many shares is traded, the close, that's so there's a high, a low during the day, and then it closed at 50. Net change was $50 for the close of the previous day. But again, I'll show you a chart here in a second that makes much more sense than this. Broker, yeah, the problem with brokers is a lot of times they number one, work on commission, so they want to churn things. They want you to buy and sell quite a bit. So that wasn't really in your best interest. And then the other thing was they sometimes would have certain stocks that they had some sort of arrangement in and were trying to get it pushed up. I'm not saying these guys are as devious or as corrupt as, say, pump and dump scandals, but if you ever watch Wolf of Wall Street and some of those other things, they were dealing with penny stocks, which are much shadier because they're not SEC, Securities Exchange regulated, so they can get away with certain things. If you're, say, an officer, if you're somebody like Elon Musk, and you make comments about a stock that you hold, and you know they find out it's has a manipulation effect or it's a less than true statement, I mean, you can go to jail. It's serious stuff. So larger stocks where they're under the SEC guidelines, it's a little bit more business-like. In the Wolf of Wall Street type thing, they would do basically a pump and dump. And what you do in a pump and dump is you get a stock, preferably a penny stock, and this is on steroids with the internet, because what you can do is you get some cheesy stock and you buy it at, you know, a fairly low price, and then you pump it up in the trades in the internet, you know, just rumors. You try to generate price momentum where people think this is the next big thing, and so, you know, you buy it for a couple cents a share, you know, and you really hype this stock through whatever means are necessary, not even honest means at all, and then say it gets to a quarter, you know, 25%, you sell everything. And with that big sell that you've just done, there's not enough buyers on the other side, so the stock price just falls. But you don't care because you sold. You pumped it up and then you dumped it, and you leave a lot of, you know, broken people behind. So that's how that works. Not all stocks are like that, and not necessarily in the big boys. You know, on the some of the larger companies, because there's just too much information out there, too much knowledge, and they're not as susceptible to rumors. And you've got people who, if they're found to be involved doing that sort of action with an SEC, you know, traded thing, they're going to find themselves in a lot of trouble. So anyway, broker skills. So I'm not going to talk too much about brokers. Commissions, yeah, if you're paying anything right now, you're paying too much. I've bought many, you know, share transactions, and I don't think at least in the past 5 years, I haven't paid a dime of commissions because it's not necessary. There's people out there who many of the firms, all of the big firms don't charge commissions. Placing an order, so you got to know what stock you're looking at, ticker symbol, but it's dead easy and it's fun, and you're buying or selling. This whole business of round lots, aught lots, in the digital realm, people don't really care. The exchanges, back in the day, 15 years ago, you had to buy in certain multiples if you're buying stock, and that's what made mutual funds more advantageous, because you would buy those just in set dollar amounts. You could buy, $100 worth of whatever mutual fund every month, and that was not a problem. Whereas back in the day, you said, oh, I want to buy 10 shares of this every month, and, they'd have a problem with it because the dollar amount would be changing. Anyway, now digitally, it's pretty seamless. Market limit stop orders. We'll talk more about this as we go, but what happens is the reason why stocks sell at a certain price is because there's somebody who wants to buy at that price. And so it's this beautiful thing that stocks find their level. When somebody says, my Disney share is worth $50, well, the only reason it's worth $50 is because there's somebody out there willing to buy it for $50. If there's nobody out there willing to buy it for $50, then it's not worth $50. And so that price is going to fall. And maybe it falls to $40, and all of a sudden there's somebody who's sitting on the fence goes, yeah, I'll do that at $40. And so now that's the new price. So let's say you want to buy 100 shares of something, and you put in a market order. It goes into the market right then. And if it's a highly traded stock, it is, a lot of volume, a lot of shares traded each day. You're probably going to get it right about what what the price is, listed. If it's a very, lightly traded stock, there could be a substantial spread. Also, if you're doing it after hours, or maybe, getting near to the Christmas holiday, or some weirdness where there's not a lot of people in the market, there could be some fluctuations. So most people don't do that. But you will see, sometimes around the holidays, you'll see a low and a high that's just kind of extreme. And it's like some poor whatever got involved in a transaction where there wasn't enough volume. There weren't enough buyers and sellers to make it a nice fluid market. Okay, so if you say, well, I don't want to take that gamble. I see this stock, and I've kind of got a life here, and I know that this stock, it's trading right now, let's say it's trading for $61, but the past couple of days it's been bouncing around from 60 to 61. I don't want to sit here and waste my whole day watching it and trying to time it exactly. I'm going to go ahead and put in a limit order to say, if this, I want to buy 100 shares, but for no more than, $60. And so let's say that stock price, it's trading for 61, and all of a sudden it dips down to $60. Boom, your limit order is activated, and it now becomes a market order, and it goes in, nearly instantaneously, meaning that you will probably get at that price. But again, it's converted to a market order, so there may be a little fluctuation, but probably not much. Stop orders. So I mentioned this before. I was trading Twitter a bunch, and it was doing this range between $30 and $60. And what I would do I would buy at 30 and sell at 60. And I did this, I don't know, I want to say 5-6 times. And so I'd see the stock price, working in that range. And let's say it's trading at 60, and now it looks like it's going to 61. It looks like it's still got some momentum. And I'm like, wow, I think this stock is going to go higher. And my target goal was $60, and I'm happy if I get out for $60. But man, I'd sure like it if it went to 65. So I really don't want to sell right now. I don't want to execute a market order. How about I just issue or enter a stop order, meaning that if the stock price keeps marching up, well, I'm going to put in a stop order for say $60. Meaning, if the stock price keeps marching up, it goes from 61 to 62 to 65. Well, since it never touched 60, my stop order never gets executed, right? So let's say a couple, 3 days go by, and now it's at 65. I'm like, this is great. I'm making some money here. I am now going to increase my stop order to $64. And so the price, marches away from that. And then all of a sudden there's a bad day. Boom, it drops through 64. When the price hits 64, my stop order now becomes a market order, and boom, it's I'm out of the market at pretty close to $64. And you can do all types of things like this with it's sort of automated trading, and it is. I mean, I don't have to sit there and watch the computer. I place the order. I don't get too emotional about it, and I step back and I came up with my strategy, and I just let it execute. There's also a trailing stop, where I can say, I don't want to set it at a dollar figure. I'm going to set it at a percentage. If it drops so much off the percentage of the high, then it's going to execute. I'm going to put in a trailing stop. I can do all sorts of different orders to sort of automate the process, and also not get me wrapped up in some, kind of eBay mindset where I'm thinking I'm winning because I'm in some sort of auction. You're better off to come up with your goals and execute your plan and move on. So we talked about, number of shares. We talked about a market order. We talked about a stop order, another type of stop order. So you can use them on the bottom or on the top. Placing an order online, lower commission. Yeah, 0 commission. So kind of the way it's done. Buying a stock on margin, kind of scary. So margin, leverage, those sort of terms, that means borrowing money to make your purchases. And you can even just do this with crypto, which is pretty insane. I have absolutely 0 problem, borrowing real estate, for that. That's called a mortgage. That's typically what's done. But with stocks, to buy them on margin, that's a little bit more dangerous. The Federal Reserve, so the federal government here, or their constituent of that, necessitates that the margin is going to be 50%. So let's say you want to buy $1,000 worth of a particular stock, and you buy it on margin. Well, you could, just put down $500 in cash and buy the rest on credit, but you would be right at the margin limit. Now, if the stock price goes up, you're good. Say the stock price, you bought $1,000 for the stock and it goes up to $1,100. Well, your margin is denominated by that 50%. So you only borrowed $500, and now that 50% of that $1,100 is what, $550. So you're good. But if the stock price goes down, you're no longer at your margin. You've got the stock prices dropped, and your money, your margin that's securing that loan, in essence, is in the stock. And so since the stock value went down, you're going to get what they call a margin call. The broker, or the text message or whatever you get, is going to send you a message saying you need to add money to your account, cash, to get your margin back up to the 50% level. And if you can't do that, they go ahead and sell the stock for you. And when do they sell it? They sell it when it's down in price. So if you're holding this in a cash position and the market has a bad day, maybe you can ride it out. Maybe you can put up a little bit of volatility, and it goes down $50 a day, and maybe comes up 100 in the next day. You could ride that out. But what happens if you have a margin call? It's going to sell you at the worst possible time, at the bottom of that trough. So short selling, kind of cool, but what you do in this case, and this was a lot of Wall Street bets kind of stuff, AMC, some of the game stocks where they did this. What you do here, and I did it with Tesla one time because I this was way back, but I expected Tesla stock to go down a little bit, and it did, and I made just a teeny bit of money. But what you do is you sell a stock, or you can be on different ways on this transaction, but you delay the time between when you pay for it and when you buy it. So you're going to sell a stock at let's say that you're expecting the stock price to go down, and let's say the stock price right now is $100, and you sell short, you sell 100 shares, and so 100 shares, at $100 would be what, $10,000, right? So anyway, that's how much you owe, but you're delaying when you're paying for it, and you're going to pay for it at the new share price. So let's say whatever the terms of the sale are, let's say that a month from now that same stock is trading for $80, and you need to now buy those shares. You could buy them for basically $8,000, and you could make $2,000 in the trade. Short selling and stuff like that, it's kind of beyond, because it gets real confusing. There's all sorts of examples you can look at to kind of explain this to you, but it kind of tumbles your mind a little bit. But anyway, it's it's something that can be done, and you can be involved with mutual funds that do short selling, that have some of these more aggressive strategies that you yourself may not want to execute, but you may want a fund trader who's executing those things or cognizant of it, so he has that option, he or she. Okay, analyzing stocks. So technical analysis, fundamental analysis. Technical analysis is these are the chart guys. These are guys who look at charts and can make patterns of them, and frankly do pretty well, quite a bit. But the part that isn't very attractive to me, isn't very intuitive, is the fact that they don't really consider the company so much. They're not. I'm not a technical analysis guy. I'm more of a fundamentals kind of company, or fundamental analysis. So a technical analysis, I mean, you could get somebody with all the price data and the charting, and they could sit in a closet in a vacuum and try to predict where the price is going to go based upon charting characteristics. Whereas fundamental analysis, you're looking more holistically at the whole picture. So I did pretty well with some Lululemon type, well, not type, Lululemon stock. And part of that was based upon, well, number one, I have a few daughters, and I know, their affinity towards that product. And then also just being on campus, seeing, all the Lululemon products, and just kind of realizing the quality and unique kind of niche they had, that company, they had a good product, seemed to be run pretty well, and that was it. Now it's not necessarily as easy as all that. I mean, those are useful reasons to be interested in a stock, but you would also want to dig in and look for other recommendations from people who do this for a living. Most of us are not going to be full-time stock traders, but if you can find a third-party unbiased recommendation, that would also add to it, and then looking at their financials. And again, if you don't have the skills to analyze that, look at it. Look at somebody else's review and how it stacks up against other companies in that sector. Lululemon, you want to see how, Nike or Athleta or whatever rivals, how they stack up. Under Armour, and again, Lululemon's kind of unique in that regard, that they don't necessarily have a great peer, and so they have a bit of an advantage. Okay, financial condition. So for a lot of us, this might be beyond to just look at a financial statement. I mean, some of you may be a little stronger in your accounting practices, but just the same, when you're to look at a single balance sheet, you would want to look at it compared to its peers, compared to other balance sheets and income statements for other companies in that sector. So, impact of firm stock price. Yeah, there's a lot that goes into this. Right now we're seeing, just a lot of things related to the interest rates, especially in the high-tech sector, when they were kind of giving money away. There was so much money out there to be invested. It's such a cheap rate. And maybe Silicon Valley has kind of run its course in terms of product innovation, in terms of, technology. I don't know, but it was good while it lasted. But investor confidence, and it's all supply and demand, and it's all forward looking. You're not buying a stock. A stock price is not necessarily the value of the company right now. It's what its outlook is. Fraud. Yeah, Bernie Madoff, everybody like that. There's always going to be some fraudulent things going on, but the signs were certainly there, and bigger than this would be 2007, 2008. We had the mortgage crisis back then. They got a bunch of sketchy mortgages, they bundled them together, and again, there's some pretty good movies out there that, I feel bad recommending the Wolf of Wall Street. Some bits that are kind of over the top, but the theories that they talk about in there, in terms of pump and dump, in terms of penny stocks, all that stuff is pretty true. And The Big Short, and the fact that people were duped into thinking that if you got a bunch of sketchy investments and you put in a big pile, suddenly it wasn't a big pile of poop. It was somehow different. It had changed because there was more poop there. It was still poop. So, alrighty. GDP, gross domestic product. We know what that is. Fiscal policy. A lot going in on that, and international economy. So we're seeing what would be a recession, and I will still call it a recession because that's the definition. 2 quarters of negative growth in the GDP equals a recession. So not positive financial times, but some people are making money. Interest rates. So interest rates perform when interest rates are low. Yep, we're seeing that. Some stocks, high tech, more sensitive. Yep. Federal Reserve tries to use monetary policy to change the rates and tries to things. There's a lot of things going on. We've got a war in Ukraine. We've got all kinds of stuff going on. Inflation. So, consumer price index. Sometimes too, there is some politics involved on how they calculate inflation rates. It's actually probably a little higher than it's being stated. But at a certain point, there'll not be enough buyers and prices may come down in a negative direction, which again isn't good. So they try to keep things level if they can. So most people are trying to stay on the sidelines right now, trying to assess what's going on. And there will be, these things go in trends. And we had been on such a positive trend for so long, but it's kind of gotten played out. So other factors, strong economic growth, which we don't have. Low interest rates, nope. Low inflation, we've got high. Strong industry. So anyway, the firm is important, the product is important, but some of the companies have got such a headwind with the higher interest. It's tough. Yep, always difficult. All right, so that was stock prices. Now we'll talk a little bit about bonds. So whereas stocks represent an equity position, bonds are just a loan. Bonds are just a larger loan. And so they may be private bonds, corporate bonds, or they may also be, government bonds, municipal bonds, whatever. But they constitute a loan. You don't own part of the company. You just have a position there. So long-term debt security. Par value for a bond, face value. So, a $20,000 bond, you will get $20,000 if you kept it to maturity. But if you try to sell it early, which, is completely legitimate, you can sell it early, that interest rate is going to affect how much you're going to get for it. And so that's, again, where these banks got in trouble. They bought bonds that were paying a low interest rate. Newer bonds that come out that are paying a higher interest rate. Therefore, their $20,000 bond, might be worth, say, $18,000. And they're using that to back up assets in their bank. And so now they don't have as much in terms of assets. So they pay interest payments, and then they repay the par value. Call feature. A call feature is not a good thing for you as a holder of the bond. What that means is if, say, interest rates go the other way, interest rates go lower, and they're paying you, say, a bond that pays like 10%, and all of a sudden they're like, wait a minute, market conditions are better. We can sell bonds and only pay 5%. We don't want to pay 10%. So we're going to call that bond. We're basically going to cancel it. And here's your, 20 grand back or whatever. And the deal's off. We get our bond back. So not good for you, because just when you're about to, make a killing, they call it all off. Convertible bond, not very common, but yeah, sometimes they can be converted back and forth between shares. Bonds yield to maturity. So if the bond sells at par value, its yield rate equals the coupon rate. So unique language, but it's not that complex. Tell you the truth, it's just been such a negative area for bonds. I haven't held them in a while. Now that interest rates are going up, I certainly wouldn't want to be holding any bonds, but I may want to buy them here in the future if the interest rate gets higher, to the point where I anticipated interest rates coming down and me holding the higher bond. So anyway, a little discussion on bonds if you want to look a little further into it. Yep, we talked about how bonds can be sold just like stocks in the secondary market. So you can sell your bond early. Will change in response to interest rates. T-bills, T-bonds, whatever. They're going to, they're backed by the federal government. So the interest rate is not going to be high because there's no substantial risk involved. So some people who have, requirements for a lot of security and aren't really worried about the inflation consequences might find a reason to buy these, but for most people, not so much. Municipal bonds. Say they're going to build a stadium, a bridge, a school. They might sell a bond like that. A lot of times they may be exempt from interest, federal tax. Federal bonds are not going to be tax deductible. But again, a federal project, if they're going to build something to raise money, they may do that. Corporate bonds, yeah, subject to default risk. You know, theoretically, well, the federal government, if they default, we got real problems. Municipalities, though, certain cities have gone under, not good. And with corporate bonds, the rating is quite important. So, again, high yield, you know, in parentheses, junk bonds, meaning they are the same thing. If somebody's trying to sell it to you, yeah, they're going to call it a high yield. If somebody's being realistic about it, they're probably going to call it junk. What this means is that this company may have defaulted, may be on the brink of defaulting. By defaulting, meaning they're not going to be paying any interest, and they're going to not even be able to give you your money back, and they're going to go out of business, and you're going to be in a bit of trouble. It's not like stock. You know, if you own stock and the company goes out of business, that wasn't their company that went out of business. You own part of that company. Your company went out of business. With the bond, I guess you're in a slightly better position, but it's only slightly because the people who owe you money lost all their money. So although they still owe you the money, where are they going to get it? You get in line with the rest of the creditors, the rest of the people who are owed money. So bond quotations, same sort of thing. But again, I'm going to show you some charts that'll make this a lot easier. But things you'd be interested in are going to be spelled out. They're going to do it in a table here. Again, not so useful. Impact of interest rates. So kind of beat that to death. You know, if the interest rates go up, yeah, value of your bond decreases. If the interest rates fall, when they're, you know, nearly zero as they've been for the past whatever years, that wasn't very likely. So there wasn't really a great reason to hold bonds because the value of a bond really couldn't increase. Tax implications. We'll have a problem on that to show you a little bit about how that works. You have to know what tax bracket you would be in. Yeah, you could use some of those calculations to look at the rates. And then there's some economic impacts. So the risk is obviously the company goes out, defaults, doesn't pay anymore. Not good. Moody's, Standard & Poor's, and again, the ratings on these are, you know, it's AAA and AA, and when you get down to B-rated bonds, you're getting down into junk. So you may think, oh, I didn't do bad on that paper, I got a B. If you're buying bonds and they're B-rated, you should be a little nervous. Impact of the financial crisis, so obviously anytime there's a crisis, don't make the payments. And when the economy's weak, yeah, your security is going to be diminished. So this is what I was talking about. So anything below double B is junk. Moody's, Standard & Poor's, slightly different, you know, mainly has to do with the case, you know, uppercase, lowercase, but you can see, you know, that the unless it's up in the A range, probably not something you want. Now, the least risk bonds are probably going to pay the lowest rate because you're not experiencing much risk. You don't need that much benefit. You get down here to these junk bonds, if they don't default, you're probably going to make a great rate. But you're going to have to, you know, put up with that threat that they're going to go under. So risk and reward are completely related. Talked about calls. Talked about interest rates. Yeah, sometimes people say, I'm going to time this out because, in 10 years, I've got 20,000 right now, and in 10 years, I'm going to make this large purchase, so I'm going to tie it up in a bond and select a maturity, but you could sell the bond early, you could do all sorts of things. Interest rate strategies. Yep. Purchase long-term bonds and expect rates to fall. I don't think they're at their highest right now, so I don't think that them falling right now is realistic. But there may be a point here in the future where it looks like they're hitting their top, and there will be some smart people who will get in on that and then have some benefit. Different strategies. Again, I've never been that much of a bond investor. Most people in personal finance, the personal level there's the stock market up until recently, and there's always dips, but had been making about 10% per year. And that's over the course of 100 years. So with those kind of returns, and that includes, the Great Depression, that includes, the 2007, 2008 kind of crash in there. On the long term, they make it. The term project, I've talked about that a little bit. It's still out there. I'm not going to dwell on that so much tonight because I want to go look at some of this charting data. I'm going to look at, we could use anything right now. In fact, let's look at Google Finance real quick. So, something like this. This is, when I say don't buy penny stocks, yeah, who bought a penny stock? Thermal Genesis. These guys had an unusual thing. They did a split, 5-year. So I got in back in here. I still think I'm going to be all right. But anyway, you can see looking at just tab data and the high, low, it's not so. I can't really make decisions off just a small little snapshot. Volume compared to what? I mean, I need more information. Let's look at a better, and here it's telling you it's traded on NASDAQ. It's called Thermal Genesis. Yeah, Meta is not doing well, I don't believe. I'm not a big proponent of, so that's Meta Platforms. Yeah, so formerly named Facebook. I didn't know there were Meta Platforms. I thought it was just Meta. So it's in the tech sector. What I tell you about tech sector, they really like low interest rates. And Facebook in general and the whole metasphere, I don't know that a lot of us are, existing in the metasphere. So, I mean, they're coming back. They hit a dip down in here. But, this was a high of 378 back in September 2020. I mean, you can just see from this chart that compared to looking at raw tabular data, there is just so much more information and insight to be gained. News, I mean, it's just so much more powerful than what we had before. And I think we can go like this, where I can drag it across. I can say, oh, okay, between those dates, it's down this much. Or I bought it in here, and I'm holding it right there, and now I know. Come on, do it for me. I think it'll tell me, up 105% over that period. Kind of cool, so much more information. I can look at whatever time period. When was Facebook started? I guess back in here is probably when IPO. Whatever, 1 day, 5 day, 1 month, 6 months, year to date, 1 year. I can get down into the weeds. I can look at stories, income statements. It'll also maybe have some of the competitives out here. It will show me the other charts. It's just neat stuff. Let's look at, I usually use Fidelity. I don't have anything with Vanguard, but big brokerage firm. Mutual funds, IRAs, ETFs. So these are the type of these kind of mega companies that you wouldn't want to use them probably for your daily banking. You could, but it'd be a little whatever. I think in an ideal situation, some sort of local kind of bank or maybe an online bank, and then try to put your real money into another company, perhaps one of these, Vanguard, Fidelity, T. Rowe Price, whoever, and that way you'd have sort of a separation between the two, where you could, not have the same issues. Let's get over here. So anyway, personal investors, retirement plans, financial professionals. We're just a personal investor. Again, kind of glitzy sites. They're trying to sell you on their own stuff. But if I want to look for a mutual fund, these guys are going to, offer it. Now, am I going to go onto the site directly and look for the mutual fund? There's other companies, like Morningstar, that rate the different companies, and so that would be a little less biased. Investor education resources, all kinds of stuff in here. If you're perhaps working on a term paper and you're like, ooh, how much, it's telling me I need to figure out how much I need for retirement. Lots of good plans in here, lots of tools, lots of things you could. Social Security, we talked about, you need to know kind of how much you would get under Social Security. The Social Security site will help you, but these guys also will be more than upfront to tell you about Social Security, because it doesn't hurt their business model to let you know that you probably don't want to survive on Social Security alone. You probably want something else going on. I'm trying to find a mutual fund, and I'll give up and come up with a different means if that doesn't work. Most of the time these guys are located in Boston, typically. Products, mutual funds. They'll have their own mutual funds. They should have some Morningstar related. They may have their own products, but let's try and delve in. We've got different types of mutual funds. This is how they're filling them up. We've got a dog over there who thinks she's building a nest to have more puppies. She's got enough puppies. Need any more? Okay, let's look at here's how they're dividing them up. They've got large ones, large value, large growth, blue chip. So again, these are kind of marketing terms. And here's how they divide it up. $10 billion worth of assets is how they divide it. Let's look at one in particular. And then this is what I was talking about, the top 10 holdings. So my point is, let's say you're trying to buy, a mutual fund, and you think, I don't care about stocks, I just want a mutual fund. Well, guess what? Mutual funds are made up of stocks. So here's Apple, here's Microsoft, Nvidia, Amazon, Google, Tesla. So all the usual players, Meta. So sometimes too, people think, oh, I'm diversified. I've got a Fidelity mutual fund, and I've got a Vanguard mutual fund, and they're all the high growth ones. Well, if you look at their underlying holdings, 50% of these guys' portfolio is in these top 10 stocks. A lot of times you'll find out, oh no, I've got incredible exposure to the same companies over and over again. So it's kind of funny. So this is a ticker symbol. So you can see in this case it's kind of odd because Google, normally it's part of the thing, but when they changed their name to Alphabet, that's where it went. Marvel Technology. Is that like Marvel, the MCU thing? Anyway, you look more information. These are kind of cool, different type of chart. Volume down along the bottom, high and low display. Anyway, just so much more information. All the tab data is still there, but you know, with a snapshot, this is much easier to make heads or tails over other stuff, and it's real time. Unlike, you know, some sort of newspaper quote that they're talking about on the slides in the lecture. More information, stories that are driving it, things that are going on. So this is nothing to do with the MCU. This is you know, chips and stuff, system on a chip architecture, high tech kind of stuff. So anyway, cool. You live and learn. I once bought. I think I bought Twillo. I thought I was buying Zillow. It's probably one of the smartest purchases I ever made. Every once in a while, a blind squirrel finds a nut. I thought I was buying Twillo or Zillow because I thought, oh, that, you know, that part of real estate is coming through, and I bought an entirely different company that was just slightly different, but a great purchase. So anyway, enough of that. It's getting late. Sorry, 1 hour. Welcome back. If you have any questions, let me know. But this is kind of how it works, and I'd take you through one of the trades, but it's easier than ordering food. I mean, and it actually is. It's kind of addictive, kind of fun, if you're actually trading stocks. I'm not recommending it for everybody, but you know, it does. You should have your disciplined money you're going to invest, you know, to generate your wealth. But that incremental difference, you know, I could save another $100 a month, and you know what? I'm gonna go ahead and buy some stock with that and kind of play the market. You'll probably learn a lot in the process, and you'll have a little bit of fun, and it's much better use of your money than, you know, casino gambling where the house takes a huge percentage. At least in the stock market, you can do better. All right, this place is falling apart. I will talk.